Hello, welcome to the channel. Today I'm gonna give you the perfect day trading plan as if I was to start trading today. Day trading requires a different type of discipline because it's a specific type of trading where positions are open and closed within the same trading day, meaning that you're gonna see a lot more opportunities compared to swing trading or long-term trading, and I'm gonna give you a list of steps to follow so you can apply it on your sessions and achieve a better level of success. A lot of people think that having a plan is not as important as long as your strategy works, but this is false and further from the truth. Having no plan can turn your working strategy into a complete losing strategy. Because during our testing, we're not looking at multiple assets, which means correlation will not have an impact. You can also sabotage yourself because you can see what price will do, or you can bend the rules to make it fit on your desired outcome. But don't worry, that's what this video is for. I will help you develop a plan, so let's get to it. Okay, so the first thing we want to do is to avoid high impact news. It's gonna be around 1 hour to 45 minutes, maybe 30 minutes before the news come, and 10 minutes to 30, maybe 45 minutes after. This is gonna be a little subjective, so you wanna think for yourself a little bit here, but you can keep an eye on things like spread, gaps, cleanness of price action, or big moves. Keeping an eye on all these things is gonna help you judge the situation better and make better decisions when it comes to trading when news are about to come, but you don't know if you should resume trading yet. I'm gonna go into a different chart and show you some examples. Okay, so we talked about spreads. The spread, we know that it's the difference between the bid and the ask prices. We know that spreads have a cost, so we might wanna wait for price to get tighter, for spread to get tighter in order to resume trading. So for example, we can see the bid and the ask prices here. If you see a sudden move in spread like this, instead of being here, bid and ask, is around here, maybe around here, it means that price is still being affected by the news. This can happen before the news drop, during or after. So this is one of the things to look for to see if you can resume trading or not. Now, we also talked about gaps, and I'm gonna explain this in a second. Price normally behaves like this. There's a candle right after the other. There's another candle right after the other, right after the other. There's no significant difference between the space of this candle and this candle. Same with this, there's no significant space between these candles, and same thing with this. But sometimes before news come, during, or even after, you will see that there's some candles that behave in a different way, like this. One candle, and instead of being right after the other, there's a big jump in between. There's a lot of space between these two candles. These are called gaps, and this can happen when volatility spikes, as higher volatility usually means that there's gonna be larger price swings, making it more likely for price to jump or drop significantly. This is how a gap is created. Now, we also talked about cleanness of price action. We want to look at this because if you see tons of wicks, for example, like this in a specific area you're interested in, like this, or maybe price is moving sideways, price moving choppy, especially before, during, or after news, this might be a sign to ignore. We want price to be clean, to be decisive, to have a clear direction in order to resume trading. And also, we want to avoid really violent and huge moves. For example, like just like this. You can see how the size of this candle and also these three candles is way bigger than these others. We want a confluence of things happening. Like I said before, we want spread to be tight, we want no gaps, we want cleanness of price action, no wicks, no sideways. And big moves are okay, but there's some type of moves like the ones I just showed you before that are clearly being affected by news, and we want to avoid that too. If you don't know where to look for high impact news, you can go to pages like Forex Factory, my FX book, and look them up as economic calendar. So for example, we're here on the Forex Factory website. We're gonna go into calendar and look for the red folders. It will be this one, it will be this one, and all these red folders. There's also a little bit less important news, which are the orange folders and the yellow folders, which are the less important ones, but you want to keep an eye on all of them. Just remember that the red folders are the high impact news and most important ones. So pay attention when you're trading. And also, if you don't want to sweat it, just ignore news completely. If you see that news are coming, just chill out, completely forget about it because you shouldn't even be trading during news. Me personally, every time that I see news coming, when it's coming near and I haven't put a position, I'm not in a position currently, I completely get off the market and come back an hour later. So you can just not sweat it and take a break when news are coming. Okay, so the next step is to not trade correlated pairs at the same time because it's basically the same move. Let me explain. Okay, just imagine you're analyzing the market, you're checking out Euro USD and GBP USD. They're both setting up, so you decide to enter a trade on both of these pairs. Let's enter on this at the same time, both at the same time, because they're both setting up, right? Well, guess what? You got the same result because both of these are correlated and they're moving in a similar way. You can zoom out a little bit and see how similar they look. So it's basically as if you just enter one trade and increase your risk twice the size of what you actually do, because this pair and this trade is gonna do the same move as this pair because they're both correlated. And that's why sometimes in backtesting we get different results than in real life, because in backtesting we only have this pair. We're not constantly looking at both pairs, and when we hop in the live market we have so many more options to look simultaneously, and just like that we're gonna get very different results. This can actually turn your equity curve to look like this and turn it to something completely different, even into a losing strategy, because you're trading correlated pairs and instead of losing one trade, lose two trades. And sometimes even more, because there's way more than one or two correlated pairs or assets. So it's normal that you take 1, 2, 3, 4 losing trades in a very short amount of time, because there's a lot of correlation going on in the live market. And that's why sometimes you don't get the same results in backtesting than in a real environment. And this is something that you definitely want to keep your eye on when you're trading on the live markets. And this brings me to my next rule, which is to only trade one asset at a time. You only want to trade one asset at a time because of, first, correlation, because sometimes even things that aren't really correlated are moving in a very similar way, which is going to lead you to have the same result. Like I said before, this is how you don't get the same results in backtesting than in the live markets. So you really want to avoid being on multiple trades at the same time, just as you will do on backtesting. And also because you need mental clarity. You can't be managing 2-3 trades at the same time. Sometimes when you want to enter very fast, you forget to put your stop loss, you manage accordingly. Maybe you have to close positions and you didn't have time to because you were closing the other one. So I want you to have mental clarity and be focused on only one trade at a time. All right, the next step is to be on a maximum of 2 to 3 trades per day. Why? Because when you're day trading, you're likely gonna have a bunch of opportunities, and it's very easy to just go crazy once we hit our first stop loss or second stop loss. So we're gonna from 2 to 3 trades per day. Now for some people this might seem like a lot of trades, but it's really not, especially if you're diversified and looking at all kinds of assets like stocks, commodities, cryptos, pairs, and all these kinds of things. Also remember, we're day trading here, so we're likely on the 1 minute, on the 5 minute, maybe even on the seconds charts. So it's really not that unusual. But also, I know that to some people this is nothing and this is way too little trades, but you want to have a limit. Because like I said, once you hit your first loss, maybe your second one or your third one in the day, you should understand that the market doesn't go your way every day. And if you keep trading the same price action of the day, you're likely to have the same results, or even to the point that you break your rules, you over leverage, you over risk, doing all these kinds of things that don't make sense. And when the day ends, you get the post-trade clarity and you're like, what have I done? This doesn't make sense at all, you know? So remember, the lower the time frame, the more setups you will have. So make sure that when you're trading, do not exceed or maybe 3 trades per day. Alright, now the fifth step, which is 2 consecutives of anything, we have to be done for the day. This means that we get 2 losses, we will be done for the day. If we get 2 break-evens, we will be done for the day. Even if we get 2 wins, we will be done for the day. And to be honest, even if I get a single win, I could potentially be done for the day. Especially if you're just starting to day trade live, we really want to protect our capital the most. And I will even go as far as to say that this is our main priority. Alright, now we reach our sixth and last step, and that is to set a risk and stick to it. Now this will vary depending if you're on a personal account, on a prop firm, your commissions, if you have a high win rate or low win rate strategy. For example, you have a 60, 65 and above strategy, you could use a risk of 1 to 2% on a personal account, but for a low win rate strategy, like 30, 35, 40%, you could risk 0.5, maybe 0.3, all the way to maybe 1%. And for challenges, this is gonna depend on your max drawdown allowed. So for example, if the max drawdown for your challenge is 10%, I will look at how much I will have to risk for my personal max drawdown to match that 10%. And then I will cut the risk in half. So for instance, if I will have to risk 100 per trade, or let's just say 1% per trade for my max personal drawdown that I have tested, and I seen on my data collection that that's the amount I will have to risk to reach 10% drawdown, I will take that risk and cut it in half. So that way it's basically impossible for me to reach the max drawdown. And instead, pass the account. Just imagine this is your data collection and this is your equity curve. You want to look at your war streak, and then you want to look for the percentage that you need to reach at 10% max drawdown. Remember, you're going to take into account your war streak, which will be this one. Now, in this example, I need to risk 1% in order to reach the 10% max drawdown. And what I'm going to do is, instead of using 1%, I'm going to use 0.5%. So instead of hitting the max drawdown of 10%, like we did here, we only go halfway through and go here. That way, instead of reaching the max drawdown, we only reach 5% drawdown. And don't get it twisted, since we're taking our war streak, there's still a very high chance that you pass the challenge even if you risk 1%. Just remember, when you're doing all these kinds of things, take spread and commissions into account, and you know exactly what's happening. Alright guys, thank you for watching this video. If you want to join my private mentorship, link is in the description. We go more in detail, we answer more questions, so feel free to do it if you want. Other than that, I'll see you guys on the next one. Peace out.